Welcome to our channel. In today's video, we'll explore a pressing concern for many consumers, the impact of high inflation and rising interest rates on loans and your financial future. Entitled, The Impact of High Inflation and Interest Rates. Why you should think twice before taking that loan. This video aims to empower you with essential knowledge to navigate these challenging times. As inflation skyrockets, many people find themselves considering loans to cover unexpected expenses. However, it's vital to understand how increased interest rates can significantly affect your repayment burden. First, let's briefly discuss what inflation and interest rates are. Inflation is a term that we often hear in the news, especially when the cost of living seems to be rising. But what exactly does it mean? Essentially, inflation is the rate at which the general level of prices for goods and services is rising, and subsequently, the purchasing power of currency is falling. Central banks attempt to limit inflation and avoid deflation in order to keep the economy running smoothly. Inflation is the rate at which prices for goods and services rise, eroding the value of money. For example, if the inflation rate is 2%, a pack of gum that costs $1 today will cost $1.02 next year. This might not seem like much, but over time, inflation can significantly impact the cost of living. Imagine the price of groceries, gas, and other essentials increasing year after year. This gradual increase can make it harder for people to afford the same standard of living. When inflation is high, the purchasing power of your income decreases. This means that even if you are earning the same amount of money, you can buy less with it. For instance, if your salary remains the same, but the prices of goods and services increase, you will find that your money doesn't go as far as it used to. This can be particularly challenging for people on fixed incomes, such as retirees, who may struggle to keep up with rising costs. Simultaneously, central banks often raise interest rates to combat inflation, making loans more expensive. Interest rates are the cost of borrowing money, and they play a crucial role in the economy. When inflation is high, central banks, like the Federal Reserve in the United States, may increase interest rates to try to slow down the economy and reduce inflation. Higher interest rates make borrowing more expensive, which can reduce spending and investment, and ultimately help to bring down inflation. Higher interest rates mean that the cost of borrowing rises, which can lead to larger monthly payments and total repayment amounts. For example, if you have a mortgage or a car loan, an increase in interest rates can result in higher monthly payments. This can put a strain on household budgets and make it more difficult for people to afford their loans. Additionally, higher interest rates can also impact credit card debt, student loans, and other forms of borrowing, making it more expensive to carry debt. For businesses, higher interest rates can mean higher costs for financing operations and expansion. Small businesses, in particular, may find it more challenging to secure affordable loans, which can impact their ability to grow and create jobs. This can have a ripple effect on the economy, as reduced business investment can lead to slower economic growth and fewer employment opportunities. Understanding the relationship between inflation and interest rates is crucial for making informed financial decisions. Whether you are a consumer trying to manage your household budget, a business owner planning for the future, or a student learning about economics, knowing how these factors interact can help you navigate the complexities of the economy. By staying informed and being proactive, you can better prepare for the potential impacts of inflation and interest rate changes on your financial well-being. Let's take a look at some concrete examples to understand the implications of borrowing during these times. Example 1. Home loan. In today's economic climate, understanding the nuances of borrowing is more crucial than ever. Whether you're a first-time home buyer or looking to refinance, the decisions you make now can have long-lasting effects on your financial health. Let's delve deeper into this with a real-world scenario that many can relate to. Taking out a home loan. Imagine you're in the market for a new home. You found the perfect house, and now it's time to figure out the financing. You decide to take a $300,000 home loan at an interest rate of 2.5%. This rate seems quite favorable, especially when compared to historical averages. At this interest rate, your monthly payment would be approximately $1,200. This amount includes both the principal and the interest, and it's a manageable figure for your budget. However, it's essential to consider the broader economic context. Interest rates are influenced by a variety of factors, including inflation, economic growth, and monetary policy. When inflation is low, central banks tend to keep interest rates low to encourage borrowing and investment. But what happens when inflation starts to rise? Let's explore this scenario further. Suppose inflation rises and, as a result, interest rates climb to 5%. This is not an uncommon situation. In fact, it's a scenario that many economists anticipate in the coming years. If you were to take the same loan amount of $300,000 at this new interest rate, your monthly payment would shoot up to around $1,600. This increase of $400 per month might not seem like a lot at first glance, but it adds up quickly. Over the course of a year, that's an additional $4,800 that you would need to budget for. This extra expense could impact your ability to save for other financial goals, such as retirement, education, or even vacations. Moreover, higher monthly payments can strain your household budget, leading to difficult financial decisions. You might find yourself cutting back on discretionary spending, such as dining out or entertainment, to make ends meet. In more severe cases, you might need to dip into your savings or take on additional debt to cover the increased costs. It's also important to consider the long-term implications of higher interest rates. Over the life of a 30-year mortgage, the difference in interest payments can be substantial. At an interest rate of 2.5%, you would pay approximately $126,000 in interest over the life of the loan. However, at an interest rate of 5%, the total interest paid would be around $279,000. That's a difference of over $150,000. This example illustrates the importance of understanding how interest rates and inflation can impact your financial decisions. It's not just about the monthly payment, it's about the total cost of borrowing over time. Now let's consider another aspect of borrowing, the impact on your credit score. When you take out a loan, lenders report your payment history to credit bureaus. Consistently making on-time payments can help improve your credit score, making it easier to qualify for future loans at favorable interest rates. However, if higher monthly payments strain your budget and lead to missed or late payments, your credit score could suffer. This in turn could make it more challenging to secure financing in the future, creating a cycle of financial stress. It's also worth noting that higher interest rates can affect other types of borrowing, such as credit cards, auto loans, and personal loans. As interest rates rise, the cost of borrowing increases across the board, making it more expensive to carry balances on credit cards or finance a new car. This can further strain your budget and limit your financial flexibility. In conclusion, understanding the implications of borrowing in a changing economic environment is crucial for making informed financial decisions. By considering factors such as interest rates, inflation, and the impact on your credit score, you can better navigate the complexities of borrowing and protect your financial well-being. Whether you're taking out a home loan, financing a car, or using credit cards, being aware of these factors can help you make smarter choices and avoid potential pitfalls. So, as you plan your financial future, keep these real-world examples in mind and stay informed about the economic factors that can influence your borrowing costs. Example 2. Personal loan. Now consider a personal loan of $10,000. At a 5% interest rate, your monthly payment over 3 years would be around $300. If inflation pushes the interest rate to 10%, that same loan would now cost you approximately $350 per month. But why do so many rush into taking loans, even when the terms aren't favorable? It's often due to the psychological allure of quick cash. The need for immediate financial relief can cloud judgment, making individuals overlook how these loans will impact their long-term financial health. When interest rates are high, the total interest you pay over the life of the loan increases significantly. For consumers, this can lead to a cycle of debt that becomes unmanageable. The key is to evaluate whether the loan is genuinely necessary and what alternative funding options may exist. So, what can you do during these challenging times? Financial stability is a goal that many strive for, but it can often feel elusive, especially during periods of economic uncertainty. However, with the right strategies and a proactive approach, you can navigate these challenges and build a more secure financial future. First, budgeting. Carefully assess your current financial situation and create a budget that prioritizes your needs. Budgeting is the cornerstone of financial stability. It involves tracking your income and expenses meticulously. Start by listing all your sources of income, including your salary, any side gigs, or passive income streams. Then, categorize your expenses into fixed and variable costs. Fixed costs are those that remain constant each month, such as rent or mortgage payments, utilities, and insurance premiums. Variable costs, on the other hand, can fluctuate and include groceries, entertainment, and dining out. By understanding where your money is going, you can identify areas where you can cut back and allocate more funds towards savings or debt repayment. Consider cutting unnecessary expenses to free up funds. This might mean dining out less frequently, canceling unused subscriptions, or finding more cost-effective alternatives for your daily needs. For instance, brewing your coffee at home instead of buying it from a cafe can save you a significant amount over time. Additionally, consider negotiating with service providers for better rates on your internet, cable, or phone bills. Every little bit helps, and these small changes can add up to substantial savings. Second, emergency fund. Aim to establish an emergency fund to cover unexpected expenses without resorting to loans. An emergency fund acts as a financial safety net, providing you with the peace of mind that you can handle unforeseen expenses, such as medical bills, car repairs, or sudden job loss. Financial experts typically recommend saving 3 to 6 months' worth of living expenses in your emergency fund. Start small if necessary, setting aside a portion of your income each month until you reach your goal. The key is consistency and making it a priority in your financial plan. Third, explore alternatives. Look into non-loan alternatives, such as community assistance programs or financial aid that don't require repaying borrowed money. Many communities offer resources to help individuals and families in need, including food banks, utility assistance programs, and housing support. Additionally, there are numerous nonprofit organizations and government programs designed to provide financial aid for education, healthcare, and other essential services. Research and take advantage of these resources to alleviate financial pressure without incurring additional debt. Remember, seeking help is a sign of strength, not weakness, and utilizing available support can make a significant difference in your financial well-being. Education is another crucial component of financial stability. Investing time in learning about personal finance can empower you to make informed decisions. Consider attending financial literacy workshops, reading books on financial planning, or even taking online courses. The more you know about managing money, the better equipped you'll be to handle financial challenges and seize opportunities for growth. Knowledge is power, and in the realm of finance, it can translate to greater security and prosperity. Finally, think about long-term financial goals. While it's essential to address immediate needs, planning for the future is equally important. This might involve investing in retirement accounts, such as a 401k or IRA, or exploring other investment opportunities that align with your risk tolerance and financial objectives. Diversifying your investments can help mitigate risk and increase the potential for returns. Regularly review and adjust your financial plan to ensure it remains aligned with your goals and changing circumstances. In conclusion, achieving financial stability requires a combination of careful planning, disciplined budgeting, and proactive measures. By assessing your financial situation, cutting unnecessary expenses, building an emergency fund, exploring non-loan alternatives, educating yourself, and planning for the future, you can create a solid foundation for financial security. Remember, it's a journey, and every step you take brings you closer to your goal. Stay committed, stay informed, and stay proactive in managing your finances. Remember, don't let the allure of quick cash lead you into a financial trap. Be informed and strategic about your financial choices. If you found value in today's video, please like, subscribe, and leave your thoughts in the comments below. How have high inflation and interest rates affected your financial planning? We would love to hear your experiences. Thank you for joining us. Stay informed and empowered.